Hi, this is our Forex blog for November 19th, 2013, and these are our currency indexes, which I honestly think is the easiest way of trading the Forex market because it lets you see what each individual currency is doing. Uh, these are indexes just like the S&P 500, NASDAQ, Dow. We take all the euro pairs and basically create a synthetic index that doesn't exist anywhere outside of our software, and it lets you see what each of them is doing. For instance, the euro, you can see a trend line off the highs. You can see it formed a double bottom here and volatility is getting lower, preceding this explosive move up. You also can see the hourly moving average. Currencies underneath the hourly, and notice that trend line here in the dollar before it broke and it fell significantly. So when the dollar did fall significantly here, let's zoom out, or let's find a currency that's strong when this breaks down right here. The euro is kind of going sideways. The pound is underneath its hourly. The yen is also, plus the yen has a weekly, monthly trend that's down. Let's look at some of the other ones here. You can see the Australian is the strongest right here. Now the outer bands, typically the white bands contain price most of the time, so it's got a good distance to potentially travel. Coming up to 2 o'clock, one of the higher probability trades would be looking for a buy in the Australian dollar. Now, the key to trading is small losses, big wins. This doesn't always work, but when it does work, you typically are going to make a big profit. Now look, in this case it did work. Coming up to 2 o'clock, this one was already trending up. The dollar broke down, and you can see it went from 9,400 up to 9,445. 45 pip profit, or potential of, while having a super tiny risk. When you buy these breakouts, when they take off, this, actually it's a little bit less than that, this is a little bit bigger than what your real risk is, and this is how far it went. Now even if you got half of that, it's a multiple of 2.5 to 3 times more profit than what your risk is, and that's the key to trading. Every new trader that I talk to always asks, well, what's your system's win rate? What percentage does it work? I mean, that's all new traders think that's the key to trading, and it's complete bullshit, because I've seen traders that have 90% winning trades that wipe their account out and lose everything, because they take 3 pip wins, and then when a trade goes against them, instead of taking a small 5 to 10 or 15 pip loss, they let it grow and it becomes 50 pip loss, and then 100, and at that point it's very painful for them. Half their account's gone. They hold on to it, and they've lost 200 pips. So anyway, getting back to this, focus on the probabilities, and let's scroll into the future here, and you can see a little bit later in the day, the dollar rallied back up to hourly. Typically you get a pullback here, it didn't. So you can certainly look to buy the dollar here when it breaks out right here. Now that trend didn't continue, but you can see at the time the euro's near its lows and the pound's also going down. So let's take a look at the pound dollar at that particular time, coming up to 6. Now this trade may or may not work, but the point is, if it doesn't work, you're probably going to lose a tiny amount. Here's coming up to 6. You get short here when it breaks, and you can see it did work. It did go your way, and it did go your way in a significant amount of pips compared to what your risk is. It went 3 to 4 times more your way than what your risk is. And I like Van Tharp's book, Trade Your Way to Financial Freedom. He defines risk as R, and R is just simply what your risk is. In this case, this. And he measures everything in terms of R multiples. So if your likely profit target is 1.5 to 2 times more than your risk, so this would be 1 times your risk, this would be 2 times your risk, this would be 3 times your risk. This is a 3R trade here. And if you focus on this is basically called positive expectancy systems. You don't have to be right even half the time. Now, I personally have developed these currency indexes in our perfect oscillator and a slew of other tools that I could really confuse traders and make them think our systems are too complicated. It's not complicated. You're going to have some losses. Deal with it. If you can't deal with the fact that you will have losses, there's no 100% winning system, then you're not smart enough to be a trader. It's that simple. You're going to lose all your money. Smart traders realize they're going to have some wins, some losses. The wins, on good days, you're going to have a lot more wins than you do losses. And the wins are going to be a lot bigger than your losses. And on bad days, you're going to catch a bunch of small and medium-sized wins, break evens, and hopefully you catch one big win that gets rid of your losses, and maybe you have a small loss for the whole day, or maybe you're up a measly 5 to 10 pips. But that's the way trading is. There's so many ways to use these currency indexes. I mean, you can see that this was the high of today. It double bottomed right here. It's chopping around. It breaks out right here at 10. Now, which currency is weakest at 10? Well, it's the yen. Now, the only downside of buying the euro versus the yen at this point is it's already at the lower band. One day out of maybe every 10 days, currencies go underneath these bands or above the upper bands and keep going. So you can certainly take that trade, but it's going to be a short-lived profit of maybe an hour at the most. So let's bring that up. At 10 o'clock, we're looking for a euro-yen buy, strong euro, weak yen, 10 o'clock. And, like you can see here, it went up, and then for about an hour and a half, it kind of went sideways because the market's at a statistically likely reversal area. And so you got to be very careful buying up here because most of the time it reverses. Once it goes up here, usually about an hour, hour and a half, that's about an hour right here, you can consider buying again right here. But again, this is pretty much at its peak, and you're not likely to make much money on this last trade right here. So you take whatever you can get. But even on that last trade, the potential, because you're in a strong currency versus a weak currency, it still has a 1.5 times R. That's your risk. The profit is 1.5 times that, so that's 1.5 R trade, which is good. That's what you want to focus on. Focus on trades that are likely to give you bigger wins and losses, and it's pretty easy to actually do that by using support resistance, Fibonacci profit targets, using our software's containment bands on the chart. Typically, currencies don't go past the chart's 2.0 white band, and so and you want to use the DSP on there. So you can see it went past it, and this is kind of the area where it's going to run out of steam. It kind of went sideways right here. You're getting in it, but you're not expecting much more profit. The 2.5 white band typically contains price probably 80% of the time. Tags that area. Let me just put some other currencies in here so you can see it in action. Hit that price, reversed. Hit the bottom one, reverse. Hit the up one, reverse. So there's so many different ways of trading with our software. It's absolutely insane. But the currency index is the easiest. You just basically draw trend lines on these charts, and when they break through, if the euro is strong, find which one's weak. I'll end this with finding one other currency that maybe is weak. You can see the yen's weak. The pound is starting to go up here. You don't want to trade the euro versus the pound. The CAD's weak. Of these 4 currencies, the CAD's the weakest. So let's take a look at, coming up to 10 o'clock, the Euro CAD. It's a very high probability one likely to go your way. And of course it does. Look, coming up to, you see a little trend line break right here. It went up about 20 pips. You see a little pullback. Never, you redraw your trend line off the lows here. Breaks out right here. You get in again. You put your stop underneath that little swing. And even if you got out right here in the sideways move, your risk reward is pretty high, and it's not at or above the upper band. So when it breaks out of the high right here again, you put your stop here, drill it up. I would probably get out of the trade here because usually that's where it runs out of steam, and you can see it made one more wave up. But again, when they're outside of our bands, typically they reverse, and they almost never go through the 3.0 band. If you really want to start looking for safe, or I should say safer counter trend trades, put the 3 on there. And when those, gets up there at those extremes, you can really start to do some aggressive counter trend trades. Here's the euro yen. Look, you get short, make money. Get short, make money. So there's so many different ways. Trading with the trend, against the trend. You can draw a trend line on the chart here. When that long-term, multi-hour, hopefully 8 to 12-hour trend breaks that trend line, you can get short. You can draw trend channels on currencies, and when you draw a trend channel, you project it off the high, and a lot of times it will come up and hit the projected trend line off the high. Let me just show you that here with the Swiss to end today's lesson. So you have a trend line here, projected off the low. Guess what? I mean, this is why I'm saying this is so easy. Once you have that projected trend line from here, you have potential reversals here, here, and here. Now, obviously, these reversals are much better in the direction of the trend. A lot of times they'll come up to the upper one, you get short, and on days where the trend continues, these are ideal places to get in. And also Fibonacci retracements and fib targets work on these as well. But there's so many different ways. If you're a smart person, you'll find 500 ways to use these currency indexes. All right, so that's it for today's Forex blog.